So we have interpretation of account. For you to interpret account, it's simply about we understanding the position of the business in terms of liquidity. What do I call it? In terms of liquidity and the performance of the business. The performance. These are the reasons why we need to interpret accounts. I'm going to kick both of you out. I'm serious about it. You know it already. You know why I don't want. I'm serious.
Okay, sorry, mistake.
So, interpreting account, it's about we understanding the performance of the business. And to do that, we need our statement of financial position and our statement of profit or loss account, which is this. So we have our statement of profit or loss account, and we have our statement of financial position. So how have we done through the year? We get to know. So the question says, we should calculate the gross profit margin. To calculate the gross profit margin, we need to understand the gross profit. But the gross profit is already missing here. In the previous question, let me just. This was not given. So here it was question mark.
You add this up?
And for gross profit, we need to find gross profit before the gross profit margin. And gross profit is what?
Where does it say?
Gross profit is sales minus cost of
Sales.
sales. Thank you. So this minus this is our gross profit. Do you get that? Are you guys with me there? Are you guys with me?
Yes.
Okay. So this gives us 0, 0, 0, 5,
305.
0, 305. That's our gross profit. I see that is clear.
Yeah.
Now that we have our gross profit minus expenses gives us our net profit. This is the net profit. Done. But the question is not about it. The question is about finding the gross profit margin. To get our gross profit margin, it is gross profit margin. Gross profit divided by sales multiplied by. So what's our gross profit? We have it as 305, right? 305,000 multiplied by 100 over. What is our gross profit? Our sales? 650,000.
Can I calculate?
Yes, please. So we have 650,000 here. No, brilliant. Now, what does it give you, please? Are you guys with me?
You need it to the decimal.
Yeah, 2 decimal. 46.92%. Do you understand gross profit margin?
47.
Is it? Let me see. 46. Yeah. Thank you. So we move on. The next question. I think gross profit margin is clear, right? So the next question.
You have to write it.
Yeah, we'll do the right. You can solve the second question, then we'll write it. The next question says we should find acid test ratio. For acid test ratio, it is current assets. Please. Current assets minus closing inventory. Divided by current liabilities. Move there. So what's our current asset? Go back to the question again. For current assets, we have our current assets to be 88,000, right? Our current asset is what? 88,000 current assets. Our current liability, which is, where's our current liability? We have it here. Creditor, 32,000. And we have our closing inventory, 30,000. Closing inventory. Do we get that, please? Are you here? So it is current asset minus closing inventory divided by current liability, which is 33,000. So we have 88,000 minus 30,000 divided by 33,000. 88,000 88,000 minus 30,000 divided by 33,000. What does that give you, please? So 88,000 minus 30,000 is what?
56. 42.
88 minus 30,000. Is it 88 minus 30? Let me be sure. Current assets minus closing stock. Okay, yeah.
1.75.
58,000.
1 ratio 1.75, right?
So
No, 1.75 ratio, sorry. 1.75 ratio 1.
ratio 2.
Is it 1 or is it?
It's 1.
Yeah, this is, what does this give you first? What does this give you? 88 minus 30,000.
58.
58,000. So we have 58,000. Sorry,
Okay.
58,000 over 33,000. So how many 33,000 do we see here?
1.7.
1.75. Do you get it now?
Yes.
Do you understand now, please? 33,000 and 33,000 is 1. 33,000 is 58,000 is 1.75.
Yes.
Clear now?
Yes.
Yes?
What does it say? Closing what?
Closing inventory, closing stock.
New closing stock.
Do you get that, please?
Yes.
Yes.
Shall we move on?
Yes.
Yes.
Or you want to write this first? Okay. So we have the next one. We're done with this. Now, this time we should calculate the period of credit received from trade creditors. So for trade creditors, these are our credit suppliers. How many days do they give to us to pay back? Do you get that? So to do that, we have for trade creditors, period received from trade creditors. It is creditors divided by credit purchases multiplied by 365. Creditors divided by credit purchases multiplied by 365. So what's our creditors? Our creditor is 33,000, right? Credit purchase is 342,000. Our creditor, this is our creditor. 33,000. So we have 33,000 divided by credit purchases.
This we should multiply it by the days of
The days of the year is 365, yeah. Credit purchases 342,000. 342,000 multiplied by 365. What does that give? How many days was given to us?
2.6 multiplied by 10 minus
35.2.
That's 35 days, right?
Yeah.
So we have 35 days to pay back.
You should
Hello, please. Can you just stop that? Already? So we have 35 days to pay back. So having 35 days to pay back means we're going to have more cash. Remember our cash inflow?
Yes.
When the days you have to pay back your creditors increases, your cash flow increases.
Because they will add the interest. No.
No. In your cash flow. Remember when your creditors increases, your cash increases.
Yes.
So here, your creditors are increasing. The days. So it allows you to spend more days with money than paying back. So your creditors allow you to pay back after 35 days, which is good for the business. Do you understand that? Now the next one. The rate of stock turnover. Yes? Yeah, sure. So we have rate of stock of turnover. To do that, it is. We said we should calculate the rate of stock turnover. So it is. Can I transfer here? That is over here. Rate of stock turnover. Rate of stock turnover. It is cost of sales. Cost of sales over average stock. Average stock multiplied by 365 days. Do you get that? Cost of sales multiplied by 365 divided by average stock. Now we need our average stock. I think I have to add up. Average stock is stock plus closing stock divided by 2. Are you guys with me? So what's our opening stock?
33,000.
Our opening stock.
300.
Let's go back here. Where's our opening stock? Our opening stock is 33,000.
Yeah.
Opening 33,000. Then our closing is what?
30.
30 divided by 2. What else do we have there?
It's
33,000.
63,000.
Okay. What way? 32. I want to check something here.
Cost of sales is 345,000.
345, right?
Yeah, 1,000.
Average stock. Okay. So we have. I should go back, right?
Operating profit.
No.
Why is it divided by 2?
Our average stock is opening stock plus closing stock divided by 2. Opening plus closing divided by 2. Average.
Why do we divide it by 2?
Because we need average stock
The average is we add the
Plus-
opening and the closing.
divided by 2.
Why do we divide?
What is mean?
مش نا
Mean. Mean. Summation fx over n. This is mean.
315,000.
Yes or no? This is mean. Summation fx over n.
Yeah. 315,000.
What's your opening stock? 30,000, right?
Yeah.
33 or 30?
33,000 plus 30,000
Plus 30,000.
equal 315,000.
31,500.
51,500. Do we get that? Are you guys with me?
Can you go back to the
Sure.
slide? Yeah, this one.
Okay.
Well,
Rate of stock turnover is cost of sales divided by average stock.
can you go to the last one?
Okay. This. Shall we move on now, please?
Yeah.
So, do you know why it is average now, right?
Yeah.
Yes, could you please move some?
Could you what?
Move some. Right.
So, this is your 350. Then we have our rate of stock turnover. Rate of stock turnover to be cost of sales. How much is the cost of sales?
It's 345,000.
345,000 over 31,500.
Why?
Let's check.
What's the number?
345,000 divided by 31,500.
To do this equation to solve what?
Rate of stock turnover.
3,997.
I think something. No. Rate of stock turnover is cost of sales. No. Something is missing here. Rate of stock turnover is cost of sales divided by average. You're not multiplying by 365, sorry. It's cost of sales divided by average. Cost of sales divided by average, yes.
10.9.
Yeah, thank you. 10.9, that's 11 days. 11 days. So you expect to sell your stocks within the 11 days.
Yeah.
Do you get it? Our rate of stock of turnover means the numbers of days we are expected to sell our stock. Do you get it? It is the cost of sales divided by average stock.
34500 or 30?
34500 divided by 31,500.
201.
Oh.
2 or 30?
How can it be 2 or 3? Go back to the question, please.
شوف mister, now look.
The question is what? 345 divided by this. This is 34,500. Look, don't ask me that question. Look at what we have here. It's 34,500. When I was saying, you said, Mr. Move fast, move fast. 34,500 divided by this. It's about how many days it's going to take us to sell our stock. So it's going to take us 11 days to sell it. Is that clear?
Yeah.
You guys with me, please. The next question. Explain the following terms. Depreciation. What is depreciation? Depreciation is a loss in
It's a
value
loss.
of assets
Yeah.
due
So
to
the-
wear and tear.
Depreciation.
Yeah, that's about depreciation. Shareholders' funds. What are shareholders' funds? Shareholders' funds.
It's the rate the shareholder says.
The amount of money
Yeah.
the shareholders have, invested into the business. The amount of money they have spent on buying shares. This one. The intangible assets. What are intangible assets?
You need that definition.
Yeah. Intangible assets are those assets that they have value but we cannot touch them. Goodwill, patent, these are intangible assets.
Wait, what?
Patents, goodwill, these are intangible assets. Then 7% debenture 2023 to 2024. Debenture is a long-term loan and it has to be paid back.
Explain the
Can you
venture,
write
then
Yeah.
you should write the number of.
Mister, can you write them?
Okay now. Can you write them please?
I write them.
Can you write them please? Always learn how to use please.
Okay. Can you write them, please?
Sure. Let's go back. Why are you laughing? Notes out. Is that not courtesy? It's courtesy. Debenture, depreciation, right?
The loss of assets due to wear and tear.
Yeah. A loss in value.
Loss in value.
So lovely.
Assets
It's the last two businesses were just
due to wear and tear.
Oh, yeah.
Wear and tear. The second one. The second one, please.
Wallahi, I don't know your name.
God help you. The second one, shareholders' funds.
Shareholders fund.
Shareholders,
Adebayo.
shareholders' funds.
Mr. Adebayo.
I'm doctor, okay? The amount
Dr. Adebayo.
of money spent
Ten
by
months.
shareholders. Where you going?
Sorry, can I leave?
No, see. By shareholders.
I need to go to the
Sit down, please.
I need to
There's a
go.
test here now. Shareholders on shares. I'm going to kick both of you out now. You want me to kick you out, right? The next one,
Intangible assets.
intangible assets. Yes, sir.
So lovely. Today the businesses are going to have a test
Inshallah.
about the last thing we took. Yeah?
No, about what we take now.
Not now, this one.
About what we take in the class then, not now.
Yes, the last
Yeah.
class.
Can you just keep quiet already?
لا. Dash.
Goodwill. Yeah. 7% debentures. Yeah. 7% debentures.
Mr.
Yes, yeah.
Not what? Intangible assets. These are assets. Not tangible.
But not touchable, not handy. 7% debentures. You're not alright. Yeah, so debenture, 7% debentures means a long-term loan.
What is it that?
A long-term loan, and according to the extract, it has to be paid back between 2023 and 2024 with a fixed interest. They said you should explain. They said, why is it long? No, it should be short, like short term. Any question, guys? So that's how we interpret financial statements. I remain Dr. Adebayo.